Welcome to you all. Gunjan, we've had a Fed rate hike. We've had really almost record volatility in the bond market. And yet the stock market has been relatively on solid footing. We're up for the year still, up for the week. If nothing else, I guess you could say this is not a 2022 type of stock market reaction.
Absolutely not. It's pretty wild to see that we just saw the first week of inflows into domestic funds for the year, the biggest weekly inflows since November 2022. And that just tells you that a lot of people are shrugging off some of these banking fears. And I think a lot of that goes back to the fact that tech seems to be the crisis trade. The NASDAQ is up more than double digits this year. So people are piling back into the stock market. But I really do think that's masking a lot of uncertainty under the surface. And we are seeing pockets of anxiety, whether it's in the options market, the bond market, the gold market.
For sure. Yeah, and in fact, those inflows, I think, were very much skewed toward growth funds. So chasing that NASDAQ type move. Warren, I know you're not necessarily particularly encouraged by the way the stock market's acting, given what's happening in the bond market, in the way that whole yield structure has really gotten to some dramatic extremes. Talk about that a bit.
Yeah, thanks for having me. What we've really been paying a lot of attention to since last year is this relationship between the Fed funds rate and the 2-year yield. And so this is a great proxy for forward Fed policy and during crisis periods of financial stress. And so most recently, we've seen that spread drop below 100 basis points, and this is absolutely rare. You only see this right before crisis events. So we went back and said, when does this spread blow out to 75 basis points or more? Really, it's a handful of cases. The S&L crisis, the 1990 recession, long-term capital management in 1998, 2001 recession. We saw 2 of these in the great financial crisis, one in 07, one in 08. We saw one in the 2009 repo crisis, late 2019, and then again right before COVID. So they happen right before crisis periods, this blowout between the Fed funds rate and the 2-year. And always, in every case, the market is saved by the Fed. The Fed cuts rates within weeks, or at least at the most a month, following this huge inversion. And what we saw is the Fed hiking rates just this week. And so this is odd. We're off the map. We've never seen this kind of behavior from a Fed when we have this kind of a signal from the bond market, and I would say it's pretty ominous for equity investors.
It's fascinating. I would look at that list of prior instances and maybe push back and say, obviously, they were dramatic. In the moment, they were scary. There certainly was more risk they came along with. But S&L crisis, 1986, right? The economy seemed to weather it okay. 1990, shallow recession, 20% S&P drawdown. Even 1998, some people say the Fed got too easy too quickly, given how strong the U.S. economy was. So I wonder if you can say that you don't necessarily have to have the Fed immediately go into panic mode in order to avert a bigger disaster.
Yeah, well, it's hard to always argue the counterfactual and know how history would have turned out if the Fed didn't cut rates. But in fact, every single one of those cases, the Fed absolutely responded to this inversion. And so let's think about 1998 and the LTCM for a moment and think about how much different the backdrop is. Because I see bulls making the case that, hey, the Fed could come in, cut rates right now, and this could reinflate the bubble. Kind of similar. We were up 30% off the inversion for 1998. And so is that possible? Well, think about back then, CPI was sub 2%. Oil prices were at like $15 a barrel. In the 2 months after that crisis, when the Fed cut rates by about 75 basis points following LTCM, oil prices dropped below $10 a barrel on Brent to make a generational low. So there were a lot of tailwinds within the inflation picture that are not present right now to give the Fed leeway to cut back then.